Hi everyone, so I'm going to tell you something here which sounds completely counterintuitive and goes completely against a lot of advice that people are given. There is actually not a relationship between risk and return if it comes to long-term investments. Now, as we're often told that if returns are higher, then actually it's always going to be a higher risk and that you can't get 8% or 10% by taking virtually no risk. Actually, that's not true if you're long term. I'll give you an example to actually show you what I mean by this. If you invest in the US S&P, you've got about a 45% chance on a daily basis of being down. So obviously investing for one day or even 1 week is incredibly risky, right? If you invest for 1 year, it goes down to about a 72% chance you'll win and a 28% chance you'll lose. So of course it's still quite risky. But if you do it for 5 years, it's pretty much at least an 80% chance you're going to be up. If you do it for 10 years, it pretty much goes down to about 10%. 15 to 20 years, you're going down to the single digits like 2, 5, 7%. Now, it's never happened historically where somebody has lost money in the S&P over a 25 or 30 year period. Now, that doesn't mean it's impossible, that it won't ever happen. You can't just say something will never happen just because it hasn't happened in the past. But put it this way, if you're a 21-year-old and you start investing in the market every single month from age 20 to age 70 or 65, 45, 50 years, you just invest every month. That is exceptionally low risk because what you're doing is A, you're buying at average prices, right? Because if you're buying every month and the market goes down, oh great, you're going to make more money. But B, it's long term. So actually, markets have produced 10% historically long term. And 10% invested in the S&P in 1941 would be worth 51 million today. And you can do that by virtually taking no risk. All you have to do is buy, hold, never panic when the market's down, and only hold a small amount in government bonds, like 5 or 10%, but then raise it when you're 55. And this completely goes against a lot of the advice. A lot of people talk about diversification and so on. But actually, diversification, as Buffett says, just keeps your wealth. Concentration, build this. And one of the easiest ways people can actually get wealthy investing is being 100% in low risk index funds when they're young, or 90% and 10% in government bonds. And then when they're above 50, increase the government bonds to 25%. And maybe, yes, when they're 70 years old, they could have 40% in government bonds. But having a high percentage of bonds in your portfolio, over diversifying, makes no sense. Buffett said this before. Having 90% in the S&P, 10% in government bonds makes a lot more sense than too much in government bonds. And it's so true, but a lot of the traditional advice says, well, you should always over diversify, and that's simply not true. Okay, everyone, I hope that was useful for you all.